Hello and good afternoon, everyone. Today on the final bar, a little bit of a distribution day here, sort of distributing into the end of the session. Sell off in the morning, rally into the afternoon, but then we sort of finish lower with the S&P down 1/3%. It's clearly more of a defensive mood with real estate at the top, with communication services technology at the bottom. Ladies and gentlemen, this is the final bar. Hello and good afternoon, everyone. Welcome to the final bar. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, coming at you live from our home office here in Redmond, Washington. Thanks so much for joining us today and for every day. I know a number of you have been with us since we started the show a couple weeks ago. Really appreciate it. And to all of you that have sent in feedback, questions along the way, really appreciate it. I love keeping the show interactive, love keeping the discussion going, and we'll certainly hope to do that, continue to do so next week and in the weeks beyond. A lot of good content to come your way. Did want to highlight before we get any further into the show, I'll be speaking at the Traders Expo in Las Vegas. If you've not attended this event, this is one of the largest events I think I've ever been to. It's a huge event for active investors, traders, with a number of experts sort of outlining what they're seeing. I'll be speaking on Friday evening. It's November 7th through 9th. It's in Las Vegas. You can go to the website stockcharts.lasvegastradersexpo.com. and you'll see the information about when I'm presenting. We'll certainly hope to see you there and appreciate you checking it out. So today, certainly more of a move towards distribution. We had a really good week this week going to Minneapolis and sitting down with a number of really fantastic experts. And we love talking about sort of the overall market environment. And again, a lot of caution from the conversations that we've had. And so interesting to see today sort of follow through a little more to the downside than what we've had, a little more distribution. This is a chart of the Dow intraday. You can see we opened here and then just, as the day went on, went further and further. The S&P looks a lot less crazy, sort of, cratered after lunch, sort of came back. But again, a distribution into the close, and that pattern of a sell-off into the close is something that we've seen more often than not over the last couple weeks. Let's look at the chart here of the S&P 500, updating it through the close here. So, again, we've talked for a little while about as we've rallied in the last couple weeks, sort of approaching this congestion area, this supply area on sort of that 3,000 to 3030 range. That's sort of taking the highs from this previous couple peaks here earlier through the summer, and you can see we've come up here, and then again over the last 2 days, closing below the open. That's after the doji candle on Wednesday, which was where the open and close are right about at the same level. So from that point on, we've had more distribution than accumulation during the trading day, even though yesterday was higher. Again, sort of distributing through the day. Overall, still holding up just fine, right? Obviously, we're in fairly good shape. The trend is still higher. We've had higher lows here. The question now is, are we able to eclipse that significant resistance level? And so far, we've not had it. We're not going to finish the week breaking to new highs as some may have expected. Obviously, this is a big sell-off into the close of the spiders for the last 5 days. So today, kind of an unusual day, more of a choppy day with a real reversal after lunch, kind of accumulation after midday. But again, rolling over in the last 30, 40 minutes of trading. This is how it fits into the last week. So we had a number of sort of rally days here, and then again, sort of the distribution. So again, we'll have to see. This is a lot of earnings, a lot of heavy movements on individual stocks that are causing the broad market to look just like that. Let's look at some of the individual key indexes, sectors, and themes, and see what we can unpack from today's trading. So again, the S&P down about 40 bips, taking the snapshot here. The Dow Industrials down almost 1%. So those are some of the largest, most significant companies in the U.S., obviously leading the way lower. Here again, we had the S&P 100, the Nasdaq 100 at the bottom of the list. Utilities and transports up at the top. Mid caps next, about flat for the day. So it's really the largest companies dragging the index lower today. Real estate, the number one sector. Looking at a number of charts out there, some fantastic long-term charts. Unfortunately, they're in REITs, which is not the type of place you want to see fantastic long-term charts if you're bullish on the market environment. And that's where some of the better patterns have emerged. So real estate up almost 1% today, followed by utilities also up. And then financials down at the bottom, we have communication services, technology, industrials. We'll look at some of the charts that are causing those things to play out. At the top of the list, again, we have REITs and then telecoms. That's the old telecom index, really telephone and Verizon that are driving that higher, and then banks after that and broker dealers. So financial is not too bad actually on more of a distributive day. At the bottom, retail and oil services, and then semiconductors. We're going to look at a chart of semiconductors later. That's certainly been one of the more interesting leading indicators on the equity market. So more of a distribution day, but overall still holding up pretty well. Looking at the international ETFs, we looked at this yesterday, if I remember right, the chart of India, and again, another, sort of move to the upside. A number of people had asked about, what's the best index to use to pay attention to India? So obviously there's the Sensex and the Nifty. There are a number of broad indexes that measure Indian equity performance. I tend to use the INDA ETF only because what I found is for US-based investors and advisors, it's an easy way to get access to the Indian equity market, not worry as much about currency conversion or anything like that. It's an ETF traded here. So noteworthy that through Friday, through the close here, we have it closing above the previous high, and that's sort of the level that I laid out, that 34 level. So we've closed above resistance here, which is pretty compelling. We'll have to see next week if we get some sort of follow through. You'll hear me say that a lot of times, right? When you've had a big move, you've had a big breakout or breakdown, do you have follow through? And for me, that means once you've actually moved through the level, do you have enough momentum to sort of complete the move and sort of validate or confirm what you saw here? Because a lot of times a market will close above resistance and then the next day will sort of go right back, because a lot of people are keying in on that level. They're imagining that resistance, and so they would take action, and that will cause the price to return lower. So we'll be interesting to see if we do get a follow through next week or not. Down here at the bottom, we have China, so sort of the opposite, right? India holding up pretty well. China, the FXI, again, which is a common way U.S. investors I've seen access the Chinese market, sort of rolling over today and closing lower. So again, with all of the headline risk that we have, with all the discussions of trade wars and all the geopolitical issues, again, I'd encourage you to focus on price itself and look at what the ETFs are actually doing. Use that as the way to make conclusions. In commodities markets, we had actually a pretty wide spread, as we often do with some places like coffee and copper, which is noteworthy because a lot of people consider that to be a broad measure of economic strength globally, up pretty well with some of the other soft commodities here down at the bottom. We're going to go very quickly over to the Mindful Investor live chart list. This is a list that I've sent to a number of you. Thanks. If you're interested, I'm happy to forward this to you. Just want to highlight this is not updated through today, so we'll see this come down a little bit. But this right here is looking at the S&P 500 and then the new highs. And on the New York Stock Exchange, and then at the bottom, new highs and new lows for the S&P 500. I like to kind of key in on this one. So Tuesday, Wednesday, Thursday this week, you can see sort of an increasing number of stocks making new highs. So out of those 500 companies, a number of stocks sort of making new closing highs this week. Will be interesting to see today what this happens with, obviously more of a distributive day and a little more of a downside move to see what happens though. But we've talked about the lack of new highs as the market has tried to push higher. That almost felt like that was starting to change this week. So we'll have to see. Really didn't eclipse the levels that we had back here in September when we approached new highs there. So very different profile over the last couple weeks, but something to pay attention to. And then finally, just to wrap up sort of this market recap and sort of wrapping up the week's trading, I'd encourage you to look and dive deep into the Scooter reports. We'll try to check this out a little later when we wrap up as well. But obviously a number of stocks more distributive today. Johnson & Johnson, very noteworthy. Twitter, breaking down, closing lower. Boeing, Facebook, all having pretty weak days. You saw how communication services was at the bottom, and it's some of these big ticket names like Twitter, Facebook that are certainly dragging that side of the market down. But fair to note that things like State Street were up just fine. ISRG was another noteworthy breakout in healthcare. So I'd encourage you to look through those Scooter reports, pay attention to some of those movements that we've seen. As I mentioned earlier this week, we spent some time on location in Minneapolis, sat down with a number of really fantastic, experienced technical analysts, guys like Ralph Acampora, Jeff Hughes, who we featured earlier in the week. If you missed his interview, I'd encourage you to check that out on our YouTube channel for StockCharts TV. And then we got to sit down with Craig Johnson, who's the technical analyst at Piper Jaffray, was a big broker-dealer in Minneapolis. He had some really good, fantastic long-term charts thinking about long-term equity movements and some sector and stock ideas. So wanted to hear this interview. This is from earlier this week. This is from Tuesday when we sat down with Craig, but still very relevant. And then I'll sort of unpack some of his comments in a moment. So here's Craig Johnson from Piper Jaffray. Craig, thanks so much for joining us today. First off, we were talking about growth versus value. How are you thinking that, obviously the return of value would be a total change. So how are you thinking about the growth versus value perspective here?
Dave, this is the number one question I've had as I've been marketing through Europe for the last 2 weeks is growth versus value.
Right.
And are we going to see the growth stocks reassert themselves, or are we going to see value start to take over the leadership? When I come back, I like to make this really, really simple, Dave. I like to take a simple ratio chart, dividing out growth versus value. And when I do that, I've definitely been seeing some clear indications of a crack in the growth names. I think we're probably going to see these value stocks probably continue to outperform, probably in Q4. It's going to be choppy, but I haven't seen that ratio chart turn around and see growth break above the old highs before. The other thing, too, is I think this market, even though it shifts from growth to value, I still think it can grind higher in here. And the reason I say that is right now, 60% of the market, if you take a traditional growth versus value argument with the Russell names, growth versus value indexes, you'll find out that 60% of the S&P 500 is value at this point in time, and 40% is growth, which a lot of people don't realize at this point. So from my perspective, I think you're going to see the value names perhaps continue to carry on a little bit stronger here in the fourth quarter.
Interesting. So what does that mean for the traditional FANG trade, FANG complex? How does that fit in?
Well, FANG had been the leadership, but when I go back and I look at an equally weighted index of the FANG stocks, and I include Apple in there, so FANG AA, that index, equally weighted, is not breaking out to all-time new highs. So while this market's trying to break out to new highs, and some of the growth is giving it up for the value at this point in time, FANG isn't working. That's a huge amount of market cap, Dave, that's struggling to move higher. So from my perspective, these FANG stocks are probably going to have to be consolidating further in here.
Interesting. And those are huge benchmark names. I mean, any big institution is going to have to deal with the implications of that. Second thing, any sector plays, upgrades, downgrades that you could tell us about recently?
So, Dave, we recently upgraded the industrial manufacturing sector. We're starting to see in our work a nice relative strength acceleration. We're seeing a bunch of stocks that are starting to break out to new highs. So we're definitely seeing a pickup in momentum here. And I got to tell you, there's so much pushback that I'm getting from people that, like, really, the industrial stocks now, here, what? They're going to work? But the reality is, as I go through the charts, I can see it not only at the sector level, I can see it in key industry groups, such as the defense and aerospace names, and anything housing related. And specifically, Dave, I'd throw out one stock here for all your listeners today is take a look at Boeing. Yes, they have challenges with their 737 MAX, but the chart at this point in time still continues to, from our perspective, reverse a downtrend, and it looks like it's setting itself up for another play higher.
Well, on behalf of all the people of Seattle, I have to say thank you for the Boeing hat tip. That's nice. We appreciate it. So with something like the Boeing example, if we could look at it, looks constructive here. What sort of signal or what sort of indication would suggest to you that it's the wrong call? What sort of line in the sand, or is there a particular level, particular pattern that you would be looking for?
So Dave, what I'll be watching for this stock is, and again, it's been consolidating for the better half of 2 years. And what I'll be watching for is a breakdown in either the relative strength or a break below the support that we'd seen in this stock back in the December timeframe of 2018. That's going to tell me that we're off track. But right now, that isn't even close to the case. And in fact, we're now just starting to reverse the downtrend off of the Q1 highs and starting to inflect higher on better relative strength.
Some excellent charts. Craig, thanks for sharing those with us.
Thank you for having me on.
So that was a snippet of a conversation I had on Tuesday of this week with Craig Johnson from Piper Jaffray. It's interesting. We were talking about Boeing there at the end, and I thanked him for, referring to a Seattle-based company. That was a nice gesture. Boeing down today, obviously on news. So it would be interesting to see how obviously that's potentially changed the picture from when I sat down with Craig. But the charts, especially on growth and value, we've talked about that a number of times, and I think that theme. One of the things I talked with Craig a lot about in our longer interview, which we'll certainly look forward to sharing with you in the coming weeks. We talked a lot about, sort of those broad themes and what happens when institutions get caught sort of naked or caught, unexposed to a theme. And that was one we talked about with growth versus value. And if we see a rotation away from growth into value, what that will do for institutions that are forced to, potentially reallocate. So a lot more to come from Craig, and really appreciated the chance to get inside his chart room, his office this week. We're going to take a brief commercial break. We'll be back with the Final Bar Mailbag. We'll see you in a minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Hello, everyone, and welcome back. This is Dave Keller, Chief Market Strategist at StockCharts.com. Thanks again for joining us. The Final Bar Mailbag, as you probably know, because I try to mention it often, you can email us any questions you have at thefinalbar@stockcharts.com, or get us on Twitter at FinalBarSCTV. And the number of you have sent in some really thoughtful questions. Really, really appreciate it. The more that we can make this conversation about you and some of the things you're seeing, I think the more helpful this time can be for all of us. So thanks again. So one question actually just came out of the chat room a little bit ago was about the mid-cap index. So, stocks selling off and mid-caps not off as much. So does that make the strength of the selling today suspect? So how do you think about sort of the relative sell-off between large caps, mid caps, small caps? What does that actually mean? So here we're looking at the Russell 1000 ETF down 42 basis points, Russell 2000 down a little more, mid caps not down as much. So, so does it make it suspect? I would say, listen, over the longer time, on one particular day, I think the movements of one index versus the other tends to be about individual names a lot of times, right? It's going to be, things like Boeing and Twitter and Facebook, huge mega cap names selling off. That's what's going to drag something like the S&P 100 down intraday. Over multiple days, over multiple weeks, over multiple sessions, when you see the trends. And that's what I've tended to talk more about, is sort of the lack of conviction from the mid caps and small caps over time. I think that's what makes the theme a little more suspect in terms of the broad equity advance, but less participation or less confirmation from small and mid caps. And that's not something that happens on one trading day. It's something that happens over multiple times. So would I read too much into the fact that mid caps did not sell off as much? I probably wouldn't today. But if that happens over a series of days, if that's a theme that we see continue to emerge, that's when I would question it. So again, when I keep referring to, large caps and then versus mid and small doing something different, I'm thinking of it over time, and the charts over multiple weeks are where that tends to come out a little more clearly. So thanks for that question. I hope that that helps to clarify what we saw there. Second question, we had talked earlier in the week about relative strength, and someone asked about relative strength versus RSI and how the two of those were related. So I'll show you just a chart here and talk about that. So here, this is sort of my standard daily chart that you'll see me use very, very often. If I had nothing else, I'd bring up this daily chart and just look at the daily price, the 50 and 200-day moving averages, the RSI, and then the relative strength at the bottom. And I try to be careful about what language I'm using. So when I talk about relative strength, for me, I am always talking about the relative strength, meaning the relative performance of that stock versus something else, usually a benchmark. So I'll always do it relative to the spiders on the chart. So it's UNH colon SPY, which just means a simple ratio of the one versus the other. Now it's normalized on the charts that I'm showing. So I'm starting it at a 0 point on the left side of the chart, which allows me to show the relative movement in percent terms from the left side of the chart to today, right? Or to wherever I am on the right side of the chart. So there are plenty of ways to do it. A lot of people just do a simple ratio, one versus the other, and don't worry about the units. They're just looking at the direction of the relative performance. That's what a lot of institutions do, actually. And that's fine too. You're generally just trying to get the direction of the trend, and you want to own stocks in general that are outperforming, meaning the relative line is going up, and not own the ones that are going down. So this is a simple ratio of the closing prices of the stock versus whatever's on the second side or whatever's on the denominator there. And I will more often than not use the S&P as the denominator, and it's showing you the relative performance. And that's what I mean by relative strength. RSI is the relative strength index. This was a technical indicator designed by Wells Wilder back in the 1970s, really as a way to capture mean reversion in commodities prices. But what this does is it's actually sort of standardizing the price movements. I'll give you the summary of what it's doing. It basically says when the stock closes higher on the day, how much higher does it tend to go? What's the average up day? And when it closes down on the day, what's the average down move? What's the average down close? And this takes an exponential average of those average up days and average down days over a period of many, many days. And an exponential average just means how it's smoothing it. So you keep adding the new value and calculating an average over time. So if you're more statistically minded, I tend to think of it as like a Z-score for the prices. If that makes sense to you, then great. If not, don't ignore what I just said. But all it does is it, instead of making the directional movement, sort of standardizes that into a sideways trend. And then the idea is you're looking at mean reversion, looking when a stock is oversold, meaning the price has gone too low too quick, or overbought when it's gone above 70, or too high too quickly. And in general, when things get overheated to the upside, they tend to mean revert lower. When they get exhausted or they get overextended to the downside, they tend to revert higher. So RSI, this relative strength index, and I will rarely call it the relative strength index, I'll say RSI. That's a measure of momentum, and it's based on the price purely of whatever you're looking at. So in this case, it's just based on the closing prices of United Healthcare. The relative strength or the relative performance is here at the bottom, and that's looking at the ratio of the stock versus relative to other things. I would argue Wells maybe had a poor name when he called it the relative strength index. He was implying relative movements of its own stock, but for us, relative means something very different. Hey there, sorry about that. We're back. Had a little audio issue. I think we're okay. So we'll keep going with that. So again, if you're not clear on that, look for the Chart School calendar or the Chart School article on relative strength and on RSI. It'll fill in a lot of the blanks for you. Another question we got was on cryptocurrencies. Do you have crypto data? And the answer is actually yes, we do. If you do $BTC, you'll see Bitcoin. We also have Ethereum prices, if I remember right. We're actually just in the process of acquiring some good crypto data. We're going through and making sure we're comfortable with sources and all of that before we show it to you. But I did want to let you know we do have that. So if you do $BTC USD, you'll get this chart, which is a Bitcoin data series going back. If I remember right, a $ETH USD will be Ethereum. Those are relatively new on the system. So if you're not familiar with that, you're welcome to check out crypto data. We'll continue to roll out more of that as we sort of get comfortable with data sources. And I would say things like this that you don't see on StockCharts, that's a great thing to send to me at the final bar at StockCharts.com. Part of the role here as an analyst with the management team here is just thinking about what data we have and what data we need. So things you're looking for that you can't find are really helpful. We can certainly look at acquiring the things that we think would be most helpful to you. But crypto data, easy to bring up. You just bring up, just search for Bitcoin in the top, or do $BTC USD, and you can bring that up just fine. Next question was came out of kind of a really thoughtfully, well-prepared with visual aids question. So we really appreciate that. That was nicely done. Thank you. But the question was on indexes, and this is a really challenging one, so I'll try to unpack it as best as I can. And it was looking at indexes, the Dow Jones indexes, which we tend to use. You'll see me and a lot of the contributors referring to some of these Dow indexes. I know like Tom Bowley will refer to them often. It's things like $DJ, blah, blah, blah. And those are the different ones. So this is United Airlines relative to the Dow Airlines Index. You can see that this relative line is going up, implying that it is outperformed. This next chart is United Airlines versus the ARCA, the NYSE ARCA Airline Index. You can see the relative line has been going down. So how can United Airlines be outperforming airlines, but also underperforming airlines? And unfortunately, it has to do with the indexes and how they're constructed. This is one of the toughest things when you're thinking about relative performance, because it's all about the denominator. It's all about what you're measuring it relative to. So this first one, these Dow Jones indexes, including the Dow Jones Industrial Average, is actually price weighted, which means it weights each component, each stock, by the dollar value. So if something trades for $100 a share, it has 10 times the weight of the same stock if it traded for $10 a share. Now, if you know anything about stocks, you know that's probably a pretty poor way of weighting stocks, because the higher price doesn't necessarily mean it's better or bigger or more important. That's a broad generalization, and I think it's often just a simplistic way of trying to do it. It's easy to calculate. The NYSE ARCA index is like the airline index, $XAL, is actually market cap weighted. So the bigger the company, the bigger the weight in the index. If you're familiar with like the S&P, GICS sectors and so forth, so like the XLP and XLY type of sectors, those are all cap weighted, meaning the bigger the market cap of the company, the bigger the weighting. So is there a right answer? Unfortunately, there really isn't. And we'll see that in a little bit when we talk about semiconductors. Part of the problem is depending on what index you use, you might draw a certain conclusion. So the answer is you really need to know what the index is composed of, right? What's actually causing those prices to be. And so in this case, this is more of an equal weighted index. So it's going to weight a little more some of the smaller companies potentially. And this is actually showing that United Airlines is doing better because of how that's weighted. So unfortunately, I have a non-answer for you. I can't tell you which one is right because it's all relative. All I would say is be wary and be aware of what you're using. I would say all else being equal, using a cap-weighted index is probably better because that's how most ETFs are going to be calculated, and that's how the exposure you'll actually get if you try to buy a basket of airlines. So thanks again, all of you, for sending in questions. Really, really appreciate it. Today, we're now going to finish off the final bar with the 3 and 3. As you probably know by now, at the end of every show, I show you 3 charts, the 3 and 3. These are charts that if they are not on your radar, I certainly would encourage you to put them on, because I think it's going to help you navigate markets for the coming weeks and coming months. This first chart is the first chart that I look at every day, and the first chart I look at on my weekly review of all the price action across the markets that I'm paying attention to. It is a long-term weekly chart. It's looking at the last 5. Sometimes I look at 7 years. It's the 21 and 34 week exponential moving averages. It's the PPO based on those averages, and it's the weekly MACD, or the weekly PPO, on a traditional setting, which is 12 and 26 week exponential averages. This tells me the long-term trend if the PPO is above 0, if the moving averages are sloping upwards, and all of that is telling me is the long-term trend is up. Forget about what happened this week on a price basis. The long-term trend remains higher. This tells me more of the short-term, more of the tactical trend. As you can see, this turned negative at the end of July, which is what telling me is the secular trend still positive, sort of that shorter-term trend a little more challenged. So that is how I would encourage you to orient yourself on a longer-term weekly chart like that as you're looking at prices, because everything should come after that. That should be how you prime yourself to think about long-term trends. The second chart is looking at breadth by cap tiers. We've referred to this a number of times over the last couple weeks, and I color code this, and I do it on Friday afternoons, which is why it's not updated yet, but these lines, when I update it, will all be green. This is showing you the cumulative advanced decliners for S&P 500, for the broader NYSE, for the mid-cap index, and for the small-cap index. After coming down through support over the last couple weeks, beginning of September, they have now gone back above resistance and now are threatening to break to new highs. So when the advanced decline lines are going to new highs, you have to feel okay about the overall market breadth. So now I'm going to be looking to see if they break above these resistance levels, if we break to new highs or not. And if they do, that will definitely confirm, or argue for further upside for stocks. Not quite yet. The third chart for the 3-on-3 is the relative performance of semiconductors versus the U.S. market, the spiders. In this case, I look at the SMH versus the SPY, the spiders, and you can see that this broke out on a relative basis and then just as quickly has reversed lower as Thursday and Friday have seen a little more distribution than accumulation, especially in semiconductors. Now, depending on what you use, if you use the semiconductors index, if you use the SMH, if you use different ways of measuring semiconductors, this line either broke out or did not, but overall, I would say the breakout is suspect, telling you going into next week, be a little more cautious than optimistic about stock performance, broadly speaking. That is the final bar for this Friday, October 18th, 2019. I want to thank you so much for joining us this week and beyond. You can email us questions, feedback, any thoughts at thefinalbar@stockcharts.com. Also, you can follow us on Twitter @finalbarsctv. Feel free to send us questions there as well. Hope you have a fantastic weekend. And from Redmond, Washington, StockCharts.com, this is Dave Keller. Thank you.